So, hey, Mike, where are the rates? Well, the end of last week and Monday saw some good rallies in the bond market, and that led to some slight improvement for rates compared to where they were at highs of the middle of last week. So, as of June 3rd, according to Mortgage News Daily, the average 30-year fixed conventional mortgage is about 7.125%, and the average 30-year FHA loan is about 6.625%. The average 15-year conventional rate is also sitting at about 6.625%, and the average jumbo rate is about 7.4%. Now, this is going to be a big week for jobs data, as we'll get the job openings or JOLTS report on Tuesday, ADP non-farm payrolls on Wednesday, and the May BLS jobs report on Friday, letting us know if we're still going to be sitting at that 3.9% unemployment rate, or if we'll be ticking up to that 4% mark. Right now, the expectation is that unemployment should remain about the same. But if we see it tick up even just a little bit, you can expect the bond market to react in a very positive way, along with mortgage rates. So this week's going to be another big week for the future of mortgage rates. Well, hello, Internet. Welcome to the Texas Real Estate and Finance Podcast Market Update for the week of June the 4th. I'm your host, Mike Mills, a North Texas mortgage banker with Geneva Financial. And I'm here each and every Tuesday to update you on all the big stories affecting your business each week so you can focus on what you do best, which is sell real estate. So, thank you for making an appointment to tune in with me each week and for being such an important part of our little Texas real estate community. And to all my treffers out there, that's my new term for you guys. Hopefully it sticks. All you Texas Real Estate and Finance Podcast fans who are here each week giving me just a little piece of your valuable time. I want to say thank you, thank you, thank you. You guys are the best. Now, being loyal listeners is the first and easiest way to support this show. The second way is sending those out-of-the-box tough deals our way. My team and I specialize in solving problems and finding loans for folks when everyone else has told them no. I'm sure all you guys have great lenders at your beck and call, but if you ever have a sticky situation and need a second opinion, give me a call. I'm here to help in any way that I can. My number's really easy to find, and you can reach me any time of the week. So reach out, say hello. I'd love to hear from you and help your clients get into the home of their dreams. Okay. Personal commercial over. What is on tap for today's market update? Well, first I'm going to try something just a little bit different this week. I'm going to do some what I'd call quick hits of some big stories that you may or may not have heard about that aren't necessarily related to real estate. It's just some small, personally curated news stories I found interesting and impactful. These will be really quick with little context, but just a few things to put on your radar that you may not have known about. And who knows, they might be good little party tricks that you can tell your friends about next week. It's just a little something to mix it up a bit. If you love it, let me know. If you hate it, let me know. I'm just trying to spice up our relationship a little bit. So humor me a little bit today. Then sliding down to the two-hole this week, we have mortgage interest rate updates. Where are they now? Where are they headed? And why? Then I'll share some May housing inventory data with you, nationally and locally. And if you like selling real estate and affordability, there is some good news that's trending in our direction. And lastly, I've got several quick hits regarding the recent news around the NAR commission settlements. MLSs across the country are deciding what they're doing now. Some are moving forward as told, but one big one is opting out and telling NAR to pound sand. I'll tell you all about it. NAR also released its membership updates, and there's some interesting numbers that might surprise you. But before we get started, as always, I would greatly appreciate it if you would share this episode with your network. Send it to a friend, share it on your social media sites, or drop me a review on my website. I appreciate any little thing that you guys can do to help us share our message. It's just a little something that you could do to brighten this little podcaster's day. All right, news quick hits. So first off, your Dallas Mavericks beat the Minnesota Timberwolves in 5 games to advance to the NBA Finals last week for the first time in 13 years to play the Boston Celtics. Right now, Boston's the favorite, but the Mavs probably have the most dynamic backcourt in the history of the NBA. So it's going to be nothing if not entertaining and fun. Make sure you check it out. Also in Dallas-Fort Worth sports news, the Stars lost Monday night. So unfortunately, their season is over, which is a bummer to all you Texas hockey fans out there. They had a great run this season, but unfortunately it came to an end. Do you guys remember the GameStop guy who beat all the Wall Street investors and made out like a bandit in 2021? Well, he's back at it again. And he pumped the stock 74% in one day, taking out $180 million in stock and call options, squeezing short traders again. Right now, he's already up $300 million and may be on his way to billionaire status if the trend continues. This story's insane, and it's on every financial news outlet right now, and they're covering it in great depth. So check it out because maybe you can make a little money. Who knows? Also on Monday, a quote glitch in the New York Stock Exchange sent Warren Buffett's Berkshire Hathaway stock crashing down 99%, along with some dramatic drops in several other stocks. And just to give you an idea what that means, if you had somehow been able to buy $500 worth of Berkshire stock when it crashed, right now at this moment, it'd be worth $2 million. Oops. It's all good now though, apparently, but not necessarily for the possibility of future glitches. Technical issues like this isn't exactly something that gives traders a whole lot of confidence in the market. So we'll see what the repercussions are from something like this. Recently, Bank of America raised its target price for this year for NVIDIA to $1,500 a share. It's currently trading around $1,100 a share right now and has more than doubled in price since the start of 2024. It's almost single-handedly propping up the US stock market right now. NVIDIA and the other Magnificent Seven stocks, Apple, Microsoft, Amazon, Google, Meta, and Tesla, make up over 30% of the total S&P 500 market cap, which historically is rather unprecedented. For the market to be this top heavy with so many stocks controlling so much of the market cap seems a little bit unhealthy and not necessarily good for the market overall. But again, time will tell. And finally, the house from the blockbuster movie Home Alone is for sale in Winnetka, Illinois. The 5-bedroom, 6-bath house that was the featured exterior from the 1990s Christmas classic is listed for $5.25 million. It was built in 1921. It's over 9,000 square feet. It's got a gym, a private movie theater, and an indoor sports court. Wouldn't be so bad to be left over the holidays in that house. So if you got $5 million laying around and want to reenact all those scenes from the movie, now you can. Go check it out on Zillow. It's pretty cool. Okay, that's all my news hits for today. If you liked it, want to see a little bit more, let me know. If you found this to be a complete waste of your time and want me to completely cut it out, let me know that also. Always love some good feedback. All right, now let's get on to real estate. So, hey, Mike. Where are the rates? Well, the end of last week and Monday saw some good rallies in the bond market, and that led to some slight improvement for rates compared to where they were at highs of the middle of last week. So as of June 3rd, according to Mortgage News Daily, the average 30-year fixed conventional mortgage is about 7.125%, and the average 30-year FHA loan is about 6.625%. The average 15-year conventional rate is also sitting at about 6.625%, and the average jumbo rate is about 7.4%. Now, this is going to be a big week for jobs data as we'll get the job openings or JOLTS report on Tuesday, ADP non-farm payrolls on Wednesday, and the May BLS jobs report on Friday, letting us know if we're still going to be sitting at that 3.9% unemployment rate, or if we'll be ticking up to that 4% mark. Right now, the expectation is that unemployment should remain about the same. But if we see it tick up even just a little bit, you can expect the bond market to react in a very positive way, along with mortgage rates. So this week's going to be another big week for the future of mortgage rates. The next Fed meeting is going to be held next week on June the 12th, where they're going to let everyone know if they intend to cut, raise, or pause rates where they are right now. And almost everyone believes that they're going to continue to pause rates. The most recent CPI numbers show that inflation's growth is starting to slow, and job data continues to tell us that the economy might not be doing as well as we've been told. However, the Fed will be easing how many US Treasuries it'll be selling on the open market each month, from $95 billion a month to $65 billion a month. And this is just another tool in the Fed's arsenal to manage the money supply and give a small stimulus to the market that could have a positive indirect impact on mortgage rates. And we're starting to see signs that the Fed might be headed back in the direction of cheap money. Not 2% cheap money, but they are starting to turn the Titanic that is the US economy back in the direction of quantitative easing and away from the quantitative tightening position that we've been in for the last 2 years. This isn't a fast process and isn't going to happen overnight. However, it does seem to be steering things in that direction. And all interest rates will be predicated on how the economy is doing. In basic caveman terms, economy good, rates high. Economy bad, rates low. And right now, signs are pointing to economy bad. In fact, last month in May, it was reported that the first quarter GDP grew by 1.6%. But on June 1st, GDP numbers were actually revised down. Of course, not widely reported, showing that growth was only 1.3% as opposed to the 1.6% originally reported. Pending home sales are the lowest they've been since the start of the pandemic when no one was buying homes. Layoffs are up and inflation is coming down, just not that fast. So if this trend continues, you could expect to see interest rates continue to decline over the next several months. How much and how fast is going to be dictated by how bad everything gets. So although we may all really want lower rates, the price for that will be a much worsening economy and could get very tough for many Americans, especially those on the lower income scale. But we'll continue to watch this every week and let you know when that tide starts to turn. So be sure to tune in and stay informed. All right, let's get into some inventory numbers. So we are now fully into the summertime, and as we wrapped up May of 2024, unsold inventory on the market increased across the U.S. in every single state. There are more homes on the market right now than we've had since August of 2020. And according to Mike Simonson of Altos Research, it's predicted that this summer will probably peak at around 700,000 homes for sale. New listings climbed during the past week as well. We added 72,000 more single-family homes to the market just this week. And more new listings is, of course, a good thing for affordability. But at the same time, we've really got to watch pending sales as well. What we don't want is a scenario where we have a ton of sellers flushing the market and no buyers and swing the market in a different unhealthy direction. Balance is always the key here. So good news is that pending home sales also went up a little bit this week as well, after having several bad weeks to start the year off. So right now, there are about 595,000 single-family homes on the market in the United States. And at the end of May, Texas had 106,000 of those, up from 102,000 at the end of April. Now, if the rate trend continues where we are right now, and rates stay above 7%, you can expect this inventory number to continue to grow, as the appetite for homes at 7% is pretty minimal. But if rates start to trend downward and get to say 6.5% sometime this summer, then you can expect that inventory growth to really level off as the demand for housing will start to increase. So as it stands right now, homes are sitting longer than they have been, causing inventory to grow. But new listings had somewhat started to trend downward for the last 3 weeks, which is kind of normal this time of year. So the hope is that we can get a few more positive listing numbers as we move further into the summer before they start the normal seasonal downtrend. There were also 18,000 listings that went right under contract when they came out. So basically, we had about 90,000 new sellers this past week. And that's about 10% more than we had this same time last year, which again is good for affordability. But in 2022, there were 108,000 new listings this week, which is 20% higher than they were this year. If you're in Texas, however, we're leading the way in new listings, up 20% from this time last year. Now, we do have more people here also, so we always kind of lead the trend a little bit, but more inventory is always a good thing. There were 404,000 homes under contract last week, which is up 1% from the previous week and a little over 1% higher from this time last year. So these homes coming under contract increasing is good. And what you'll see is typically a pretty good push for this all the way leading up till the 4th of July. And that's when you'll start to see things taper off a little bit. So get why the good's good this month. Also right now, about 35% of the homes on the market have had a price cut. Now that's about 4.5% higher from this time last year. And this is a combination of dwindling demand in some areas, but also a function of price expectations from sellers thinking to list their price a little too high. The median price for US single family homes on the market today is about $454,000. That's up almost 1% from last week and slightly higher than in late May of 2023. And most indicators are still showing about a 3 to 4% growth over last year in median home prices. So starting in June or July, prices will probably start to tick down a little bit during the second half of 2024. But again, this is normal as we move into the slower season of real estate and transactions start to fall even more. So as we look to the rest of this year, the big mover of the sales figures, of course, is always going to be interest rates. There's many that believe that we've hit the peak rates for this cycle and expect them to decline over the next several years. How much and how quickly still very much remains to be seen. But a decline is expected. And if rates decline, you'll start to see sales volume increase, especially if we can find our way below 6.5%. I feel like that's probably the magic numbers to really start to see sales turn around. But as always, time will tell. All right, and finally, let's get into some updates from the NAR settlement and commission lawsuits that have kind of come in a wave, but there's a lot of things that have happened over the last week that I think you guys should know about. So first off, Bright MLS, which is the nation's second largest multiple listing service in the Northeast, is set to overhaul its platform this summer to align with the new standards stemming from the National Association of Realtors' recent settlement of the real estate agent commission lawsuits. So Bright MLS is getting their ducks in a row, making sure that everything meets what the commission settlement requires to do. Starting August 14th, Bright MLS will eliminate its commission field, preventing listing agents from advertising any commissions that they offer to buyer brokers. And a written, signed buyer agreement will also be required to show properties listed on the MLS. Now, on the other side of the country, Northwest MLS, the largest multiple listing service in the Pacific Northwest, will not take part in the $418 million agreement reached by the National Association of Realtors. NWMLS said that its own rules on buyer agent compensation are fairer and more transparent than the terms that NAR agreed to in March. It also criticized NAR for pushing consumers and brokers to make secret deals off the MLS, inviting deceptive practices, discrimination, and unfair housing. NWMLS also stated that depriving buyers of information about the transaction risks is harming buyers, especially those who are already disadvantaged, including first-time home buyers and members of protected classes. So Bright MLS is all in, but Northwest MLS is all out. I don't know how they're going to be able to do that, but I guess we'll have to wait and see. Locally in the North Texas area, the Greater Fort Worth Association of Realtors and the Arlington Board of Realtors are pursuing a unification of the two organizations into a single realtor association while retaining their current MLS services. Their goals are to amplify member value, strengthen the regional voice, align with their real estate markets brokerages in cities, improve operational efficiencies, maintain local decision making, and enhance services to better support brokers, agents, and their clients. Nothing is official right now, but it is in the works. I think you're going to start to see more and more associations across the country unite as the number of agents could possibly begin to dwindle as we move into this new era of real estate. But in regards to those numbers, the National Association of Realtors reported that it had 1.5 million members as of the end of April of 2024, a decline of about 3% from the 1.55 million members that it had at the end of 2023, but higher than its numbers in February and March. Now, these April figures don't exactly break out where the losses are coming from on a state-by-state basis, but Housing Wire previously reported that the largest declines in membership last year were from Washington, D.C., Colorado, and Maryland. So overall, while NAR membership is in decline, it's still quite high by historic standards and above what many observers expected when membership dues were required by January 1st of 2024. And in modern times, membership hit a low point of about 963,000 in February of 2023 and climbed to a high of 1.6 million in October of 2022 before gradually starting to decline. Membership dipped just below 1.5 million in February before rebounding slightly since then. Now, NAR recently made the decision to remove decades of historic membership data from its website, and a NAR spokesperson declined an answer as to why that decision was made. But they did say that the trade group would continue to share updated counts with its constituents going forward. NAR's chief economist, Lawrence Yun, had repeatedly said that he expects membership to decline over the next 2 years before potentially rebounding in 2026. And industry analysts and professors say that the trade group is grossly underestimating how many members could wash out in the coming years as a result of these rule changes from the Sitzer-Burnett case. They feel that the decoupling of buyer and seller commissions will convince a significant number of realtors to abandon the field. How many is unclear, but KBW forecast projected that the changes to the commission structure could cause between 60 to 80% of realtors to leave the industry. Meanwhile, Sonia Gilbu of the City University of New York and Paul Goldsmith of the Yale School of Management estimated that about 56% of agents would exit the market if one side's commission remained at 3%, while the other became a little more competitive. And a 2015 paper in the Rand Journal of Economics predicted that a 50% reduction in commissions would result in 40% fewer agents. So as of right now, NAR's still really kind of hanging in there and not losing many of the members that it was predicted to lose. But as these new rules actually become reality in August, we're going to have to see how the membership shakes out come this time next year. Because come January, when dues are up again, that's when you're going to get a good idea of who's staying and who's going. Also related to the commission lawsuits, 2 websites recently launched to help solve this commission advertising problem. Listing Split and Nest Hook accomplish similar goals through different methods. But one thing they both do is provide a way to publish offers of buyer agent compensation online. Now, Listing Split founder Steve Hatton said one of the biggest issues with the new rule changes will be the extra workload for agents who may end up making or fielding many more calls related to compensation. He said once his site is fully launched in June, sellers can enter their addresses and how much they would be willing to offer the buyer's agent. That amount could be a percentage, a flat fee, or nothing. The quote listing will also include a link to view more details and photos from the home on Zillow. Otherwise, buyers and agents can search the address to find more information elsewhere. Hatton said that having this info come straight from the seller and not the listing agent doesn't break the new NAR rules. Eventually, Hatton said that there will be a small fee for sellers to add their information, but it will be free to create a listing at launch. He's also created a browser extension that'll show compensation information when viewing properties on other home search sites. Now, Nest Hook is another upstart that displays offers of compensation, but unlike Listing Split, only licensed real estate professionals can create accounts and see property details, according to founder Ryan Kelly. There'll be an annual or monthly rate to join the site, and while agents can view offers of compensation, they can't search listing by compensation amounts, something users can do on Listing Split. Now, both Hatton and Kelly, who are real estate professionals themselves, said they consulted with lawyers before launching their sites and claimed that they are fully compliant with the NAR settlement. Hatton and Kelly also both pointed to Section H of the settlement agreement that covers rule changes, highlighting language that indicates the settlement applies to NAR and its subsidiaries, predecessors, and successors. So in other words, not to these third-party websites. Now, you'll be seeing a lot of these sites popping up all over the place as we work through all these changes. Some will stay, some will go. Some will never show up. But either way, there's a lot of people trying to solve these problems. And lastly, in settlement news, this week, NAR Council issued some clarity about some of the minimum requirements for buyer rep agreements. In an article posted on NAR's website, it states that starting August 17th, 2024, MLS participants must have a written agreement with buyers before home tours begin. These agreements will outline the services provided and compensation details, ensuring transparency. Some mandatory provisions include clear disclosure of compensation, negotiable broker commissions, and adherence to legal duration and termination. Other optional considerations include addressing conflicts of interest and dispute resolution methods, meaning if you guys don't agree on the compensation at the end of the day, how's that going to be resolved? You don't have to include it, but they're saying you probably want to. Now, this new policy aims to clarify the professional relationship and protect consumer interests. So NAR is starting to tell you what you need to include in your buyer rep agreements so you can be compliant with all these changes coming August 17th. And if you haven't put together that buyer rep agreement, now is certainly the time. Now, I am planning another episode here soon on that very topic where we're going to go into buyer value propositions and what to have on your buyer rep agreement to make sure that you're covered. So check that one out. But that's all for today. I thank you guys for sticking around. Hopefully you got a little news you can use for this week. I really appreciate you spending a little time with me today, and I hope to have you back next week. But until then, as always, be good humans and keep grinding because life is what you make it. So make it great. See you next week.